All right, good morning and good afternoon. Thank you for joining our webinar today, Petrochemical Imbalance, Why Chemicals Are Unlikely to Prop Up Oil Demand, where we will discuss the assumptions supporting the oil and gas industry's sales pitch to investors regarding their pivot to petrochems to offset the imminent decline in transport fuel demand. My name is Hannah, and I'm part of the events and communications here at Carbon Tracker. So the intended runtime of this webinar is 50 minutes, depending on the number of questions asked, with a 60-minute hard stop. There will first be a short presentation of key points before we move into answering your questions. If you'd like to ask a question, please do so via the Q&A function. Please do not send the question anonymously. If we're unable to answer it live or if it requires a follow-up, the team will be in touch afterwards. A replay will also be sent after the webinar, as well as a link to download the slides. So Carbon Tracker is a not-for-profit financial think tank. Our vision is a fully decarbonized global economy well before 2050. All of our research converts climate science into financial risk and reward with the aim to accelerate the energy transition by mobilizing the financial markets. Our work, including this report, is free to access or download from our website. So joining us today is Saidrasul Ashrafkhanov, an associate analyst on our oil, gas, and mining team and the author of this report. Saidrasul joined Carbon Tracker in 2022 and has been lead author for Absolute Impact 2023 and Crude Intentions 2024. So joining Said today is Mike Coffin, head of the oil, gas, and mining team at Carbon Tracker. Mike joined Carbon Tracker in 2019 and now leads the oil, gas, and mining research team. His key outputs include managing peak oil, navigating peak demand, and the Paris-Malign series. And Robert Schuerk, Executive Director of Carbon Tracker North America. Rob leads Carbon Tracker's work with the securities market regulators and accounting standard setters around the globe. So, Said, over to you.
Thank you so much, Hannah. I hope you can hear me well. My name is Saidrasul Ashrafkhanov, but if you need to ask a question, you can just refer to me as Said in the Q&As. So before I start, I'd like to just walk you through a very brief plan of what I'm going to cover today. The first one is the context. I'm just going to lay out what the oil and gas companies are doing in the petrochemical space. Then I'm going to go into the main part of the presentation and the report, in which I'll cover the 4 key assumptions that these companies are making as they pivot to petrochemicals, and I will challenge them on technical, financial, and economic grounds. From then on, I'll move on to what we call a risk matrix for the different segments of the value chain for the different strategies. And finally, I will give a very brief, very short, high-level overview of another note that our colleagues have put out that describe the costs, the potential costs to refiners. So without further ado, let's start. Why are oil and gas companies pivoting to petrochemicals? Well, the answer is obvious. It's the energy transition, and it's something that these companies have recognized themselves, and I'll let them do the talking. This is ExxonMobil, which says that demand for conventional fuels is expected to peak this decade and then begin to decline. And then we also have BP, which says that oil demand falls over the outlook, driven by falling use in road transport. The outlook being out to 2050, but you'll see later on in the presentation that the decline starts to happen a lot sooner. Now, with this reality sort of hitting them, oil and gas companies are beginning to pivot to petrochemicals. And the way they do that, they also change their business descriptions, their business cards. Here you see ExxonMobil describing itself as a fuels, lubricants, and chemical companies. Saudi Aramco describing itself as one of the world's largest energy and chemicals companies, and Shell, which describes itself as a global group of energy and petrochemical companies. So obviously a very big emphasis now on petrochemicals. And you'll see that investment in the petrochemical value chain takes different shapes and forms. In this report and in this presentation, I would like to outline the 3 major themes. The first one being investment in oil production. ExxonMobil, for example, is planning to increase its production to 5.4 million barrels of oil equivalent per day by 2030. You have investment in refinery upgrades and expansions, and the example here is Saudi Aramco, which is planning to invest in so-called crude to chemicals technologies, which we'll explore later on in the report. And then you have investment in chemicals proper. And one of the starkest examples is Shell investing in an expansion of a chemical plant in South China. So the one takeaway that I think you can get from this slide is the the difference in the strategic options, and as a consequence, the difference and the complexity of the whole petrochemical value chain. This is a very high level overview, and I'd like to say that we at Carbon Tracker do not see a petrochemical industry. We don't see it as a monolithic sector. We see it as a value chain that encompasses two different industries. The first one being oil and gas on the left, which produces refinery inputs, refinery distillates, and refinery outputs, among them feedstocks. And then on the right-hand side, you find chemicals, which is primary chemicals like olefins, aromatics, etc., and then intermediate chemicals, and then end-use products themselves. So in this space, you can't also find a petrochemical company because different companies engage in the petrochemical value chain in different ways. So on the left-hand side, you can have, for example, ConocoPhillips, which is purely an upstream company. On the right-hand side, you can find Unilever, which gets the raw materials, raw chemicals, and converts them into final end-use products and retails them. And then we have BASF, which deals with the whole spectrum of chemicals. And then you have TotalEnergies and LyondellBasell, which find themselves on both sides of this sector divide. And we do acknowledge that LyondellBasell is exiting the refinery business, so it's going to become a chemical company very soon. But until it's done so, I think this slide stands. So with that outlined, we'd like to move on to the main part of the report and to outline the assumptions. Well, the thing is that it's quite difficult to find them because even though petrochemicals are now featuring more heavily in annual reports, in presentations, etc., the fact is that there is very little information available. So we were able to tease out 4 common assumptions that would usually find their way into the reports. And taking them one by one, let's start with assumption number 1, that chemical demand growth is set for strong growth on the back of growth in the global population and growth in the global economy. The problem is that it may not be so. First of all, population growth by itself is a very, very small contributor to total growth in petrochemical demand. And you can see that more, like the greatest evidence is the OECD's plastic outlook, which shows that population growth is just 8% of total growth. And the second one is that the global economy itself, the growth of the global economy itself is currently in question. We're not sure how the ongoing climate crisis and the repeated shocks may have impacted the potential of growth in the future. In addition, you have several headwinds coming from several fronts attacking the chemical demand growth. The first one is the changes in consumer behavior and regulation. And our sister think tank, Planet Tracker, has done a series of amazing reports on the litigation and regulatory risk to chemical companies operating in the space. So that might drive demand down. Then you have this movement to reuse and extend the useful life of end-use products. And one of the examples is the right to repair legislation that is currently being prepared in the EU and similar legislation being prepared in the US. Also, you have the drive to shift the sourcing from petroleum, from oil and gas, to alternative feedstocks. And what we see on the screens right now is just a very, very small selection. There are many other options available. And lastly, as a measure of last resort, increased recycling. So there is huge need and a huge drive to reduce demand for end-use plastics and along the way, all the intermediate chemicals and raw materials. Now, let's say even if growth happens at the expected rates, if it happens, let's say 2 to 4%, as the industry expects, the next assumption is that the petrochemical demand growth will be able to offset the decline in oil demand that will happen due to the decline in road transport fuels, due to EVs and wider electrification. Well, one concern with that one is, well, we find 2 problems with that assumption, and let me take them one by one. The first one is, if we look at liquids at large, the demand for liquids in the petrochemical space by chemical companies is a third to a fourth of the demand for road transport fuels and aviation and shipping fuels. So these are two vastly different markets, and one that is considerably larger than another and is set for a decline. So it is highly unlikely that chemicals will be able to offset the overall decline in liquids demand, and I highlight liquids demand. And this is something that has been recognized by some of the oil majors, including BP. This is the same outlook that I referred to at the very beginning of the webinar. You can see it going down after 2030. Now, the other problem with this assumption is that a lot of the feedstocks, a lot of the petrochemical feedstocks are sourced not just from crude oil, but also from natural gas liquids. And what you hear from companies and even in mainstream media, when referring to oil, is that the terms oil and liquids are often conflated. This 100 million barrels of oil equivalent per day is in fact 80% crude oil and 20% natural gas liquids obtained from natural gas. And because petrochemical feedstocks rely so much on natural gas liquids, it is highly probable that NGLs, natural gas liquids, will cannibalize demand for oil. And we did this a back of the envelope calculation of what demand growth in the chemical sector has to look like to be able to offset the decline in oil demand. And we found that for that to happen, for them to offset the decline in oil demand from road fuels, the growth has to happen at an annual growth rate that exceeds the annual growth rate projected, for example, by ExxonMobil. We only have the figure until 2030, but extending it out to 2035, we see a huge gap emerging in the middle, by the middle of the 30s. So that's the second assumption. Moving on to the third assumption, there is much talk, for example, from Saudi Aramco about increasing the petrochemical yield of the barrel from the current 15%, this is the global weighted average, to all the way up to 40-50% and then 70 to 80%. And the way it's described by these companies is that technologies can be tweaked, some refinery machinery can be changed a little bit to increase the yield. The thing is that this has not been proven technically viable and feasible. Saudi Aramco is commissioning one such so-called crude to chemicals technology, but it was only able to achieve a 25% chemical yield, nowhere near the 50% that Saudi Aramco targets currently, and nowhere near the 70 to 80% target that it aspires to long term. So that's one. And the second one is that even if that technology were to be proven technologically feasible, it would also need to be proven commercially viable. And the one problem with that is that the margins from petrochemical feedstocks obtained from refineries are negative. That means that they sell the NGL and the naphtha from the refinery to petrochemical feedstocks at a cost. The only way these refineries have been able to offset these costs is through significant margins from transport fuels. As you see on the screen, is gasoline, diesel, jet fuel, etc. So this is the problem with the third assumption. And the fourth assumption, we don't have a slide for it yet, but it's the change in the global trade patterns. In the case of oil, in the case of road fuels and transport fuels, the products are either fungible or very nearly fungible due to global standardization. However, as we move into chemicals, as we move into more sort of specialty products, you have a vast difference and there is a greater reliance on the global trade routes. And of course, in this case, positioning is very important. So repurposing refineries into chemical plants is going to prove a lot more difficult. And some refineries can be stranded if there is no off-taker secured. Now, with these four assumptions reviewed, let's look at the next slide, which shows the risk matrix for the different investment strategies that we outlined at the very beginning. So for the first one, oil production, it's fairly risky. misjudging the first three assumptions can result in huge losses. And the only reason, again, that there is no risk from the fourth assumption is that for oil, geography doesn't matter. It's a globally traded commodity, it's fungible, so it's no problem. Moving on to refining, there is significant risks across all four assumptions, so misjudging them can result in huge losses. So expanding refineries, upgrading refineries is a very risky prospect. And lastly, chemical production, investment in chemical production can work out in some cases, but with two caveats. First of all, the chemical demand that goes into the assumptions has to be properly sized, so it can't be overestimated. And the second one, these refineries have to be appropriately positioned. Now, in our report, we provide two case studies. The first one, ExxonMobil, and the second one, Shell, which showcase these difficulties, the geographical difficulties, first of all, and how these two companies have been dealing with them. Now, if you look, excuse me, if you look at the slide, you'll see that the middle one, the refining, is the most at risk. And I'll outline very briefly a report that was written by our colleagues in North America and the AAD team, which illustrate how big a cost these refineries can be facing in case of transition happening faster than expected. So the problem is with AROs, asset retirement obligations, and the problem is that current accounting standards allow some AROs to go unrecorded. They allow these companies, refineries, to keep them off the balance sheets. And on this flowchart, you'll see why that happens. So the first question is, for AROs, is there an obligation at all to reclaim and remediate? If the answer is no, then no, you don't record anything. If the answer is yes, then you ask the next question: can you estimate the cost of and the timing of the AROs? When will they arrive? If you can, you'll record them on your balance sheets. If you can't, these AROs will go unrecorded and they will not show up on the balance sheets. Now, what these AROs may be, no one knows exactly, but our colleagues have been able to provide a very conservative first order estimate of what these may look like for the 6 major refineries in the US. And you can see in the middle column here, the costs may go all the way up to $10 billion. And if you compare those costs with the total equity of these companies, you can see that it can go all the way up to 55%. Now, Rob, who is the co-author of the report, is on the panel today, as Hannah has mentioned. And if you have any questions on ARO specifically, please feel free to address the questions to him. Now, as we draw to the close of this presentation, I would just like to give 5 brief key takeaways, and these are just 4 assumptions reframed and the AROs repeated. So first of all, petrochemical demand growth is unlikely to grow and the industry expectations because of all the headwinds faced by these companies. The second one is that petrochemicals are unlikely to prop up oil demand. First of all, because overall liquids demand is going to go down. And second of all, there is huge competition from NGL side with oil. Then the projections of commercially viable technologies to improve petrochemical yields to the target values may be unrealistic, not commercially viable, and not technically feasible. And then changes in the chemical supply chains may leave some assets stranded. And finally, we have the fact that off-balance sheet AROs account for a significant portion of total equity and is a huge risk. So on the right-hand side, you'll be able to find the QR code to the Petrochemicals Imbalance report, and below that to the off-the-record report about the AROs. That is it from me. Thank you so much, and over to you, Simon.
Great, thanks, Said. That's a very comprehensive rundown. Now, just to remind everybody, if you would like to put in a question and answer or a question to the panel, please don't hesitate to do that using the Q&A function. I've got a few coming through right now, but what I'd like to do, if I may, is go back, focus on you a little bit, Rob, on these AROs. And the first question really is, if companies are required to report the estimated costs of refinery AROs, why are they not being reported today?
So the primary driver, and you'll see this actually in the annual reports the companies file, is that they believe that these long-lived assets, these refineries, have indeterminate useful lives, meaning they may be, they can't really estimate the timing of the retirement obligation. And this plays out a little bit differently in jurisdictions that are based on IFRS accounting rules and then US GAAP accounting rules. But under US GAAP, what happens then is, because they cannot determine the useful life, they cannot discount that cost in the future to the present value and therefore don't have to record it. Now, there is some guidance from some of the big four, including PwC, that suggests they should at least provide an estimate of the undiscounted costs in their reporting, but that's a recommendation, not a requirement. And what we see, in fact, is that companies do not provide that information.
Okay, now, and a follow-up question from Zach. The AROs, does I think it's the 34 billion US dollars, mean that there is essentially $34 billion that refiners are expecting to spend solely on replacing to-be-retired units, which takes away from what they might be spending on transitioning to petrochems? Is that the right way to look at this, or is it slightly more complicated than that?
Yes, I think one way to think about this is, so today, four of the six companies we examined do have AROs on the balance sheet, but those almost certainly relate to facilities that have already closed, have already shuttered. They do not relate to facilities that they will have to close, the ones that are currently, producing products. So what we did was we looked at some recent retirements and the estimated costs of those retirements, and we used throughput capacity as a proxy for the size of the refineries to come up with our estimate of $34 billion for these six companies. This should be thought, these obligations are the obligations to dismantle the infrastructure, to clean up and remediate any contamination that was a component of the operation of the facility. So it's not to repurpose them for something else.
Okay. We've got quite a number of questions coming through, but I do want to drop back to you, if I may, Said. You talked about a lot in the report about disclosure, and that there's not much of it. How would you recommend investors, people who've got to finance these things, people who've got to ensure them, get the information that they need? What sort of questions do they have to ask?
Yeah, thank you, Simon. Well, obviously, yeah, the focus of engagement, and they need to approach these companies and demand more disclosure across the spectrum. And the first one is obviously, what kind of chemical demand growth do they expect? That's the one question that we would like to that we ourselves have trouble with, like finding. The second one is obviously production guidance going forward, because this is important not just for oil but also for gas. And generally, if it concerns expansion into refineries or into chemical plants, an understanding of whether there is a market, whether there are any potential off-takers that they can find in the regions where they're going to set these plants up. Because, for example, in Europe, it will be potentially problematic, and both ExxonMobil and Shell have faced problems with their plants and had to either completely shut down or cut back on capacity. So yeah, I guess these are the three major ones that we have. But at the end of our report, I think it's section 7, we have a special section devoted just to engagement questions.
And I'd like to, if I may, Rob, flip that question to you. If you were seeking better disclosure from companies on asset retirement obligations for their refineries, what would you specifically ask the companies for?
So in the first instance, if I could only have one item, what I would ask for is the undiscounted estimated cost of retiring the existing petrochemical infrastructure, the refinery infrastructure. So because largely these are not on the balance sheet because they don't know about the timing. Well, okay, give us the cost. What do you estimate the cost to be? Which would be the first step in making this calculation for reporting purposes anyway. If I were to get more detailed information, I would be saying, okay, well, what are your assumptions about the useful lives of these assets? Give me a cost-weighted estimate of when you expect these retirement obligations to hit and some of the assumptions that are made there. In addition, getting information about the discount rates that companies are using to bring those future costs forward on a present value basis would also be useful.
Okay. So let's nail down a few questions on, we'll nail this down to companies. So Said, when you look at the work that you've done, which are the companies that you'd least want to invest in or would be most worried about with regard to their strategy, and which are the ones that you feel that if you were looking to finance or ensure the strategy, you'd be more comfortable with?
Thank you, Simon. Well, I have to be honest, this report is an industry level outlook. So we didn't go into deep analysis on a company by company basis. However, if we look at the general trends and the geography, I think investors and financiers should be on the lookout, first of all, on, again, geography. So where the plants are located, refineries or chemical plants, and then on the general, how bullish these companies are on future chemical demand growth. We have a report coming up on called Paris Line 3, which will give an overall overview of oil and gas companies, and this is more of focus of an upstream oil and gas that assesses on several issues. And we also have Navigating Peak Demand that focuses on risk specifically. Again, I don't think I can give you a specific company by company level answer, but that would be my reply.
Okay, and sort of staying on the geographical question, because we've got a couple of questions here. The invasion of Ukraine seems that we're starting to see oil and gas tribalism, if you like. People will buy off people, other people won't buy off people. How do you have a regional geographical outlook? Do the regulations? How do the regulations differ? When people are looking at the map, how should they interpret these factors?
That's a very interesting question. From the carbon tracker side, I don't think we can provide a definitive answer. However, I mentioned Planet Tracker before, our sister think tank. They have a series of reports on that, and the one that specifically deals with the differences in regulatory regimes is A Tale of Two Systems. It was published in December 2024, so it compares the different regulations in the EU and in the US. In addition, before that, there were reports like Toxic Footprints Europe. So I think those would be good places to start.
Okay, we've got an interesting question here from John, and he says that you mentioned, Said, repurposing refineries to petchem production was possible. Does this mean, or does this make a petchem conversion attractive by implying a potential high return on investment, and therefore avoiding stranding assets and retirement?
Yes, absolutely. But again, with two caveats, I mentioned them before. First of all, there must be demand. there must be demand growth in the potential markets. So the examples are China and North America. These are the two strongly growing markets where there is potential for off-takers. And the second one, in addition to advantageous location, you also need like strong, correct assumptions of chemical demand growth. You can't build a plant that is 4 or 5 billion tons per year and only rely on an offtake of 1.6. So they have to be measured correctly. Some plants can be, some refineries can be repurposed, but a lot of them can't. And like there are examples in Europe where even ExxonMobil had to shut down a refinery because it couldn't find off-takers. So yeah.
So what you're sort of really saying is you get this right and you're in the money. You get it, but getting it right is quite tricky.
Exactly.
Mike, I'd like to bring you in here because we've got a question from Art. And he's asking, how do you rate the OECD's outlook that global plastics production will more than double from about 500 million tons to about 1 to 1.2 billion tons in 2060? This requires global petrochem feedstock demand to increase at close to the same rate as recycling, as recycling rates remain quite low. Mike, what do you think?
Yeah, so I think there are a number of outlooks that are quite bullish on global plastics production out for quite a long way. But equally, there are, in general, we see a paucity of data and quite a large uncertainty of what the forecast for petchems, plastics and chemicals more broadly, and then of course chemicals which are derived from petrochemical feedstocks as opposed to other feedstocks. So while just pointing to plastics growth does not mean that this will drive oil production or liquids production or even oil production long term. You know, we've got the recycling trends, you've got the reuse trends, you've got the alternative sources of the carbon molecule, so from biosources and others into that plastics and chemicals chain. And I think notwithstanding all of that, the point we're really making here, and it's a very simple one at its heart, is that ultimately chemicals usage of crude or liquids demand is about a quarter of that used for fuels, so road and maritime and aviation. And so with those set to decline, increasingly so through into the 2030s and beyond, the reality is that petchems growth will not be sufficient to drive overall growth in liquids, as many of the companies, including, for example, Exxon, are saying. So you saw from Said that Exxon saying, yes, transport fuels demand will peak. And as you come off that peak and the accelerating or the decline accelerates, the chemicals growth will not be able to keep up. And so what we're really challenging is this notion that the petchems will ultimately save the day for the oil and gas industry and prop up production in both in volume terms, but of course then in price terms. And we really think investors must be very careful here and engage with corporates and ask the right questions, as Sai said in the report, of their corporates and ultimately about whether they're stewarding capital and investing wisely.
Okay. Going back to plastics and Planet Tracker's work, if I may, Saeed, just very briefly, there's been a recent collapse in the global plastics treaty talks. Will that impact your assessment in any way at all?
Yeah, that's a very good question, one that we expected. This report was published after the collapse of GPP, literally 3 or 4 days later, and it may impact the assessment, but not to a significant degree, because even though the talks collapsed and there is no global treaty, just like the Montreal Treaty, there is a possibility that some countries that do want to move on, some governments that do want to have some regulations in place will begin to implement them. And if a market as large as the EU does that, then this can pull other countries in as well to change producers in other countries change as well to change their output to comply. So that may have this sort of voluntary effect, may have the same impact. And again, for more information, I can point you to a blog written by our colleagues at Planet Tracker. It's about the INCs and the financial markets perspective on the collapse of the INC talks, also published in December.
Okay, thanks, Saeed. And Mike, just back to you, if I may. So is this report or is it fair to say that some majors are pretending that there will be a future in petrochemicals to avoid booking these asset retirement obligations?
So I'll leave Rob to come in on that second part in a moment. I'm sure he'll want to. But I think for my part, yes, I think this ultimately comes down to the challenging the industry's notion that of strong future demand for liquids, particularly, and oil, liquids and oil in particular. And so while they're now acknowledging that transport fuels might go away, well, to avoid taking the hit ultimately and closing infrastructure and assets, if you can appeal to new sources of demand and strong future demand, that can avoid that closure. So I think in short, yes. And what we're looking to do in twofold. One is I really highlight the problem here, and from kind of the oil and gas team's perspective about overdevelopment of new assets predicated on strong future demand. But I think when you come from an accounting perspective and thinking about the costs and the fact that these may materialize sooner and be greater in magnitude, at least in present value terms, that those costs come through and hit investors now. But Rob, let me pass over to you.
Yeah, I think what we have certainly seen is that prior to shuttering a facility, there will be efforts either to convert the facility, it may be from refinery to petchems. It may also be to literally storage facilities. So sometimes there's assertions that they're going to be storing things at the facility instead. But I think that those have a limited shelf life and are delaying the inevitable. And I think it's important to note that they also have to convince their outside auditors of the accuracy of that conversion. So I think you'll see that there'll be some effort to delay, but ultimately, facilities that are not economic are not going to run, and if they're not running, they'll have to be closed.
Okay, so we haven't mentioned the T word yet. President Trump, he's elected. How would you reflect on the effects to your report, Said, on Mr. Trump now being in office?
So this is an interesting one, and I think the overall position of the administration, even before Trump was elected, sort of campaign was to drill more and produce more gas. And with the possible unpausing of the LNG export, it's highly probable that gas will go up. However, this is where the problem for refiners actually begin, is as I mentioned during the presentation, the NGLs that come from gas are a huge competitor to oil. So if we assume that the decline in road fuels demand is going to unfold under, say, a moderate pace transition, in the IEA, that would be the APS, and then gas unfolds at the rate of a slow pace transition because of increased supply and increased demand, what you have is a very weird situation in which there is a free supply of NGLs, a free supply of more easily convertible feedstock. So that will eat into refineries' margins even more, because now you have to compete with a much cheaper feedstock. So we did think about this, and we have explored this so-called mixed scenario in our report, which shows that under those circumstances, actually, chemicals will have to grow at 5.2% out to 2035 to be able to offset the decline in road transport fuels. And this is well beyond the 4%, like the top 4% growth rate that expected by the most bullish players in the industry.
Okay, Mike, any thoughts?
Yeah, I think just to add in on Sai's point with a slightly kind of broader perspective too, obviously you've got the phrase "drill, baby, drill," and that's what kind of it says that Trump will be looking to do. But that's not necessarily the interest, and probably not in the interests of the corporates, because ultimately, by increasing supply of whether out of oil and of gas or the two together, you'd expect to see commodity prices fall in result. Now, clearly, oil is more global, or is global, subject to global pricing in a way that gas is less so. But particularly for a gas, drilling to reduce consumer prices is not going to be in the corporate's interests. I think there's also this point here: if you've got additional oil, and from a refining volume, what will that actually do to the refining margins as well too? So I think there is a question here of kind of what you will do, and so if for the corporates, if they, not just in the climate interest, of course, but if there is growth in the growth in supply, the corporates will very much want there to be growth in demand to provide sufficient uptake and provide stabilized prices. But without that, then the corporates would certainly be pushing back. And the reality is that demand for oil, we say, and for transport fuels does weaken. And yes, the US is behind Europe and now China too in terms of EV rollout. That is still coming, and that cannibalization and substitution of demand for transport fuels is going to continue to take place. And so we have to think about the short term against that backdrop of the transition, and there's sort of no escaping that.
And I guess that leads to a sort of question about margin side. I mean, if the road transport production sort of drops, but plastics margins are 20 times as high, who gives the stuff? Have you analysed fuels and chemical feedstocks on a margin basis?
Well, not as part of this report, but Carbon Tracker has previously done this report before, this kind of analysis before, based on Bloomberg data. And yeah, to reiterate, what we found was that the margins of chemical feedstocks that were sourced from refineries were negative. That means that they sold at below the value of the crude from which they were produced. And again, the only reason that it only makes sense for refineries to do that is to at least offset the cost. Instead of throwing that technically byproducts, instead of throwing them out, they at least sold them at a small revenue just to offset the cost a little bit. And yes, if the demand for gasoline, diesel, jet fuels, etc., goes down, and these have been the 85% of the output, and they traded at significant margins. If demand for those goes down, then, well, refineries will be in the red. So this is the biggest risk.
Okay, I want to jump about a bit, if I may, because we've got a lot of questions coming in, and a couple of them, one, are talking about what is the advantage of NGL against oil in terms of chemicals? What is the process to phase out NGL as they present another fossil fuel? And how realistic is the substitution of more renewable feedstocks into the process?
I wish I could give you a definitive answer, but I can't. In terms of NGL and substitution, well, again, it's a byproduct of gas, so it will exist as long as gas demand exists. And what happens in terms of gas is as yet unclear, although demand is probably going down in the face of cheaper solar panels, cheaper wind farms. And as for biofeedstocks, well, there is obviously a question of land use, right? So it needs to be balanced with that. However, it's not just biofeedstocks. Again, I draw your attention to what I said earlier, that biofuels is only a small portion. You have plants, you have algae, you have the byproducts of forestry, you have industrial waste, municipal waste, and again, agricultural waste. So there are many avenues. In terms of quantifying them, we haven't done that yet, but it's something that we will be looking in the future.
Okay, and another question coming in here. Where does LNG production fit into this? If Trump increases US LNG production, would this side stream add to the pressure on refineries supplying petchem?
Yes, absolutely. And again, that feeds into the mixed scenario that we have. More gas means more NGLs, means higher competition with oil. And that means even lower margins for refiners, and that means higher costs. And again, as Mike said earlier, even if the directive comes for LNG to be increased. It's a question for companies whether to actually act on that and whether to increase production. And with huge capacity currently existing that is not used, for example, OPEC with its millions of barrels of oil equivalent per day in reserves, it's unlikely that producers will want to increase production because that will drive prices down.
Rob, going back to you, if I may, just as we draw to the close of this, the report off the record focuses on the 6 US refining majors. Where can people find information on other holdings that they may have, other companies that they're looking to refinance or finance through bonds, through projects, to get more information on these asset retirement obligation issues?
So there's a couple of sources for this. Our accounting team, accounting audit and disclosure team, does a review of 140 something companies that are primarily CA 100 plus companies, looking at the extent to which they're integrating climate-related issues into the financial statements, not just in the risk factor disclosures, but looking at how these are going to be impacting cash flows and balance sheet. We have a series of company profiles on our website where you can see the ones that we've gone deeper into of those 140. So it's not all of them, it's a subset of them. And I should also mention that we look at this issue of asset retirement obligations as part of a wider piece, examining the extent to which these items are being addressed in the financial statements. And we have a piece coming out in the next month looking at what regulators in different jurisdictions are doing and accounting standard setters are doing in different jurisdictions to address or not address this, and the impact that that has had or hasn't had on companies within their jurisdictions.
So just dwelling on that point, when do you expect companies to have to record their refining related AROs? Are you expecting that relatively imminently? Does that mean that people modeling their credit analysis on these companies or looking to buy a company, how soon will they have to register that in their model as a greater threat?
Well, I think that there are a series of things that may happen that could trigger that in quite short term. So just to give you a couple of examples. So first, at the reporting level, under IFRS, obligations like these that may not be imminent often should be recorded, in fact, as contingent liabilities. That's not the case under US GAAP. So we would expect to see recordation of some of these liabilities there. We haven't done a deep dive on companies in Europe or in Canada or other jurisdictions that account under IFRS, but that is one stopping point. The second one is, if you look at how ratings agencies consider asset retirement obligations, some of them consider them debt-like obligations and factor that into asset liability ratios when they're looking at the overall credit risk for the entity, but others do not. So it's kind of a split decision within the credit ratings agencies. I would anticipate that if you see changes there may be more pressure to provide this information. And both of those, of course, don't really involve any changes in regulation or in the standards themselves. But we do understand that as part of a consultation right now, FASB, the Financial Accounting Standards Board, so that oversees standard setting in the United States, is considering this particular issue. So it may be that there could be some changes there as well.
Okay, Saeed, we've whizzed around a lot, and I think it might be, if at all possible, a good opportunity for you just to remind the people watching this what the key takeaways are from your report, because it's a very complicated report and there's a lot of moving parts, but it might just be, as we close here, a good opportunity just to remind our friends what the key takeaways are of this report, to focus their mind when they're sitting having a cup of tea after this, thinking, what do I do now?
Looking at petrochemicals from, say, bird's eye view, The first key takeaway is that this is not a monolithic industry. So companies saying that they're pivoting to petrochemicals may mean different things depending on what the company actually does. So first one is looking carefully at their strategies, asking about where they're investing, how they're investing, why they're investing. And then going through the 4 assumptions one by one is challenging them on their chemical demand assumptions, asking about what their actual CAGR is and why. The second one is if the company makes claims that they will continue to produce oil long into the future because petrochemicals will be able to offset the decline in oil demand from road fuels, ask them about what the CAGR is for road fuel, for oil demand and road fuels, and then to understand how they interact. The third one is looking carefully at the available technologies and what's actually possible in terms of converting oil into chemicals, what the margins are there, and how those compare with margins from feedstock sourced from NGLs. And the fourth one is looking at the geography, is where the new chemical plants are going to be located, and if refineries are being upgraded or expanded, A, is there a market, and B, is there an easy supply chain or an existing supply chain to tap into? That would be from our side, from the side of the Petrochemicals Imbalance, and I guess Rob has summed up the ARO note pretty well.
So what I would say is that when you read the note, there's a lot in there, but also there's a lot of questions that if you're putting together an engagement strategy that might help you fish out the answers that you are going to need to require if you're putting together a model that's going to finance something, insure something, invest in something. So do have a look at that. Mike, last word from you, if I may. What's next from the team?
Sure. And before I do that, just in one thing, I think I would really challenge that while there's a lot of debate about the exact liquids forecast and whether liquids are included or gas and NGLs, I think the predominant thing here is oil and gas companies seeking, the thing we're really challenging here is oil and gas developing new oil production based on petrochemicals demand. And I think that's the really important point to take away from here. What are we planning going forward? Well, we've got our refreshed company profiles coming out through Q1, so that we focused on some of the largest oil and gas producers, and then we'll have others through the year, including on national oil companies. And so that incorporates some of this analysis for the long time alongside our main metrics on climate-related risk exposure to the energy transition and assessments of corporate climate alignment and climate impact. We've then got our report, Paris Maligned, which should be publishing the 3rd iteration, again in Q1, ranking the corporates against each other across a suite of metrics, assessing corporate climate alignment impact. We're working on a piece and looking at the MPV analysis. Actually, are new projects value additive at all for upstream, particularly under a moderate or even a fast energy transition scenario, and really helping investors and arming investors with the right questions to engage with corporates to understand those underlying investments and whether they are value additive or not, and whether a model of harvest or natural decline might actually be value additive versus one of growth, particularly if it's replacement or even overall production growth. And then finally, we'll be doing future work on refining, taking some of the themes in this Petrochemical Imbalance report, developing them further, particularly with areas to focus on, particularly around margins and some of how that barrel does break down. What do you then do with the heavier components that it's ultimately too expensive to, or potentially too expensive to make into feedstocks? And then thinking about geographical variations as well. I think that's one thing we'd really like to stress. Companies with refineries in the OECD, well, if the growth in petchems is in the non-OECD, can those refineries credibly be repurposed if they're in the wrong place? And what does that do to the flows for products and the prices associated with that? So those are some of the themes we'll be exploring in future work on refining. So there's a lot in there, but I think we've got a lot of exciting work, which will arm a range of stakeholders with more info ultimately to engage with corporates on.
Great. Well, we hope this webinar has provided you with some insights in how the pivot to petrochems will impact the oil and gas industry, particularly focusing on the financial materiality, how you're going to work that out, and how you can work out which of the companies to be buying and which of the companies to be leaving alone. As Said said, there are 2 parts to this. There's the sort of oil and gas part, and then there's the actual downstream, the plastics element to it. For more information about the risks facing the plastics industry from, as Said mentioned, litigation or regulatory changes, and as well as for more engagement guides in this particular field on plastics, please head over to Planet Tracker's website, look for their petrochem plastics work, and their website is www.planet-tracker.org. There is a mountain of really useful stuff over there. So it really just remains me to thank the panelists. Thank you very much. Hannah, of course, for all of the support and the technical backup here, and for you, the audience, for spending what is incredibly valuable time coming and listening to us. And we look very much forward to seeing you again very shortly. Thank you very much. Bye-bye.